So if growth stocks are about reinvesting in the company and not paying out money to their shareholders, to their stock owners, to you and me, income stocks are the opposite of that. They want to pay a dividend, and that's the whole idea of your investing in them is you want that income, you want that dividend. That's income basically coming into you that you can use any way you want. Maybe you want to buy more of that company stock. Maybe you want to buy another company stock or a mutual fund or invest in bonds or something else. Maybe you want to go on vacation or use it to help fund retirement or financial independence. Whatever it is, that's cash that's coming to you that's being paid because you're an owner in that company and you own that stock. And we'll talk about dividends and more and all that too, but that's the idea is that you're going to get paid these dividends. You're going to be actually paid money by owning the stock. And that's what you're looking for if you're looking for income stocks versus, let's say, a growth stock, which is all about capital appreciation, the stock price going up. You're looking for, yes, you want the stock price to go up. You might hear like mutual funds called growth and income funds where they want some capital appreciation, stock going up, but they're also looking to grab that income as well too. And some companies, they don't grow as much. They're really all about income. So you still want that growth. You want that price increase, but you might be sacrificing some of that to get some current income now. And having dividends increase over time is also important as far as that growth phase. Not only stock, but you want your payout to increase over time as well. And that's a good thing to look for when you're looking at dividend stocks. And we'll look at about dividend growth rates and things of that nature, as far as over time. So let's say an example of a company like that would be, let's say, Coca-Cola, right? They make beverages like Pepsi, the competitor Pepsi. So Coke pays a dividend. If you own stock, for every share of stock, you get paid out on a quarterly basis a certain amount of money or a certain percentage of money that gets paid out to you as far as being a holder of the stock itself. So Coca-Cola would be considered like an income stock versus, let's say, like Google, which is totally a technology growth stock. Now, that doesn't mean that Coca-Cola doesn't want to grow. They definitely want to grow. They want to expand in new markets. They want to expand their product line by buying other types of beverages or creating new beverages or maybe getting to food and snacks or who knows what. They want to continue to grow their company and continue to grow their stock price. But they know people invest in them because they're not a high growth company, they're a steady growth company, and that people want to get income because they might be giving up some of that growth by not investing in more risky technology stock. They want to be in a less risky stock, maybe like Coca-Cola company, and get paid that income and get paid that dividend. Both types fit within a portfolio, right? You got small, medium, large cap type stocks, but then you have growth stocks and you have income stocks. You might want to have some balance between that, or weight one side a little bit more than another. So sometimes also with income stocks, the whole primary purpose is income. You'll see like utilities or things that might pay, things like communication companies or electric companies, natural gas companies, energy companies might tend to pay a little bit higher dividends or pay out that. And sometimes these people might think of income stocks as value stocks, and that's okay. I mean, the idea is you're paying for value, you're getting that regular value, but I look at it, and we're going to look at the section on value as more value of looking for underappreciated or underpriced type stocks. Could be growth or income stocks, but a lot of times you see value and income used together, so don't let that confuse you. Just understand that they could be a little bit different. Especially in mutual funds, you might see it where it says growth and value, and you might be thinking, oh, well, value, those are like what Warren Buffett invests in and other folks, they want that underappreciated stock to buy it at a discount. No, really, like in the mutual fund world, they're really talking about income stocks. So do be aware of that. And that value is more of an investment strategy, more so than how you might bucket something. Because you can find undervalued companies, or valued companies, whether they're growth or income. So income stocks, the whole idea behind that, if you're interested in those types of stocks or having that part of your portfolio, is they're going to pay you income. You might have some tax consequences of that because you're getting money now. But for people who are, let's say, want to balance their portfolio, or a lot of people are financially independent or retirees, dividend stocks are a huge part of that for them because they want that income coming in to help pay for their everyday needs is one way they can do it. So growth and income stocks. Now let's look at another type, which is kind of value. I don't look at things mostly from growth and income, but let's talk a little bit about value stocks.